Good morning, everyone. Thanks for joining us today. My name is Stephen Quimby here with Richard Waddington for our next Sherpa Funds Technology Process Alpha webinar, Understanding the Problem, Know Your Factor Bets. During today's session, what we're going to talk about is, given the recent volatility in factors throughout the end of October and November, there's been a lot of factor rotations, a lot of significant changes in what's been driving equity risk. This is really a time where understanding the factor risk, the factor biases inherent in your stock picks, and then understanding how you're implementing those in your portfolio is of extra importance. So today we're going to have about a half an hour session like we typically have. So during that session, if you have any questions, feel free to chime in during the chat. If you don't have any questions during the session, please feel free, wait. We will have a Q&A at the end, so feel free to hold on to any of your questions at the end. So with that said, we'll go ahead and get started here. So, as we look at this topic today, what we're going to be talking about, first we'll talk about why does factor bias, why is it important to look at the factor bets you have? Then we'll talk about ways that you can look to determine the factor bias in your process, because at the end of the day, everyone's process is unique, but everyone's process is going to have some tendencies for selecting for particular types of ideas that you think are likely to outperform. Then we'll look at how those factor biases can be brought into your portfolio construction process to specify the risk you want to take. We'll look at how that actually drives returns when we move forward out of sample. And then we'll talk about, from a process perspective, how you can tie all of this together to make sure, again, that you build the best portfolio to express the risk that you want to take. Questions at the end. So, like I said, the reason we're talking about this today is because there's been a lot of volatility in common market factors. There's been a lot of very highly publicized rotation. I'm sure everyone's gotten sell-side research or been on the news and seen something about outperformance in value after a multi-year shift towards growth. And so any fund manager who was not aware of the factor risk that might have been in their portfolio over the last month has probably become aware very quickly and in a very hard way. So given that in the last year, 2 years, the factor environment's been fairly stable in terms of the growth value trade-off or in terms of the momentum trade, when we see a change in that environment, a change in volatility, that's when it really matters that you have to really understand what factor bets you're taking so that you can capture the alpha that's in your ideas. So what we're going to talk about and where we're going to start today is that really, to get the risk you want and to get that risk from the alpha in your ideas, you have to really understand what other risk might be sort of present already in your ideas. So the first 3 steps that we're going to walk through to talk about this, we're going to talk about first identifying the factor bias within your alpha. So identifying what bias is in your research, what you might be seeing consistently as a result of your process. Then you have to decide what, if any, factor bias you're comfortable with, because at the end of the day, if you want a value bet, that's fine. If you want a growth bet, want a momentum bet, want to be short quality, doesn't matter. But you have to know the risk you're taking so that you're comfortable with it, so that you don't find yourself surprised or whiplashed by the market. And then finally, we're going to walk through different mechanisms to construct the portfolio so that it expresses your desired factor bias, so that you're actually capturing the risk you want. So let's talk about something that we talked about before. So this has come up in a couple of our recent webinars, and it tends to be something we talk about at the end on other topics. So what we're going to look at here, a few sessions ago, we talked about how you could, in the spirit of taking more of the risk you want, how you could construct different portfolios from the same alpha signal, varying on the amount of market risk or market exposure that you're taking. So we have 4 varying portfolios, 130-30 net long, a hedged long biased, a cash neutral, market neutral portfolio, and then a fully factor neutralized market neutral portfolio. And you can see from the graph, these produced very different results. So we looked at that at a top level, again, at the end of that session, and we saw that the cash neutral portfolio had a dramatically different risk and return profile than the factor neutral portfolio. Both were market neutral, both had beta removed, both had the same net gross, both had the same alpha. The only real difference was that the factor neutral portfolio was controlling for factor risks and for macro risks, and the cash neutral portfolio was not. And so a large portion of the risk that was driving the performance of that cash neutral portfolio in that example was that factor and macro risk. And so we could see that the results were very, very different as we look forward out of sample on that data. And we can see that those differences are largely driven by those factor and macro changes. And so if we look at this, put numbers to it, 19% from the cash neutral versus 7.5% for the factor neutral, very similar amounts of drawdown, fairly similar amounts of vol, but totally different returns, totally different lived experiences of PM. And that all comes down to the factor risk. And so in this case, the factor risk, the short value, long growth bias that was in that cash neutral portfolio had paid off handsomely. This is a portfolio that did very well with a factor bet that frankly may or may not have been intentional. So this is something that we see all the time. So at Sherpa, when we look at different portfolio managers, we see all the time that different PMs have different factor bias in their process, different factor bias in the way they generate their alpha, the way they pick their ideas. And so obviously that makes sense. Everyone has a replicable process, and if you're going to have a replicable process, you should have a consistent type of outcome, a consistent type of output. So that factor bias is not a bad thing, but how you handle it is really important. Now, just like we said, with those different market risk portfolios, any of those are okay, as long as that's what your business wants and as long as that's what you've sold on to your investors. Same thing with factor risk. Now, any amount of factor risk, if you're comfortable with it as a business, and if your investors are comfortable with it, is okay. So practically speaking, we can think about that either as taking an intentional factor bet. So we kept that, in that last case, we kept that long growth, short value bias, and that was our intent, and so we had made that bet. The factor neutralized portfolio says that we're not going to take any factor bets. We don't want factor risk to be important. And then the unintentional factor bet approach is saying that we didn't care. We made a decision not to decide. And so the first two of those are basically okay, but the third one fundamentally is fairly problematic. So first, to identify that factor bias, we have to identify it so that we can manage it, so that we can make that decision. So Richard, do you want to talk to us a little bit about how we can identify factor bias and how we can then bring that into implementation of portfolio space?
Sure. Good morning, everybody. I'm talking to you from the delightful surrounds of my quarantine hotel here in Singapore today. I have another week to go in this small room. I might just move my camera around. Apologies for doing this live, but there we are. That's better. Oh, no, it's not. Sorry. Okay, I'll stick to that. Sorry, the normal setup doesn't work when we're here. So thanks very much, Stephen. Factors, the very first thing that you have to do with factors, of course, is work out what is your factor exposure. This little table on the right here shows what the factor exposure was for that particular portfolio, for the one that's unconstrained. And let's not worry about exactly what the numbers mean, 100% or 150% or whatever. But broadly speaking, I mean, that's quite a large amount of factor exposure. How do you calculate it? Well, you need to know the factor loadings of all your assets and the weights of all your assets. How do you get factor loadings? Well, lots of different ways. I mean, Sherpa produces them. There are other third-party providers. You can calculate themselves. We're not going to talk about that in this session, although, of course, if anyone wants to talk about calculating factor loadings, we're happy to go into it. When we look at, so what we're going to do now is look at a set of portfolios, rather like the previous example Stephen gave, but we're going to update it up until today because we want to look at what happened over the last few months. And our portfolios are all generated from the same alpha signal. Now, again, we're not going to go into what is the driver, where this alpha signal came from, but I just show on this slide here an example or a extract of the alpha signal. So basically every 3 or 4 weeks, I think it's every 4 weeks, we have a signal arriving on the 700 most liquid of the Russell 1000 US stocks. So these are all highly tradable, highly liquid, large or medium cap stocks. And you can see the signal, if you just take the first row of there, you can see that on the 1st of July, there was a signal strength plus 89 on ACGL. I don't even know what ACGL is actually. And there's a minus 78 on ADB, which is Adobe. And you can see that every month the signal changes. Some stocks stay long, some go from long to short, some go to zero, which means there's no signal. So this is the driver, and this signal comes into the portfolio construction process, and it can come out of whether it's a bank of analysts or a systematic process. That doesn't matter. What matters is that this is a signal which purports to identify excess returns in single stocks going forward from the date of the signal. The signal's factor bias, if we just take that signal and we create cash neutral long short equity portfolios, cash neutral, and actually, well, yeah, let's call it just cash neutral portfolios, where we take the signal and we build a portfolio weighted by the strength of the signal in each stock at every time. You end up with a portfolio that ends up with quite a lot of residual factor exposure, right? We would, if we built this portfolio, we could tell everyone, hey, listen, we're market neutral. Well, actually, we're not market neutral. We're cash neutral. So our 100% long, 100% short. We have a bit of residual market beta, where at this point in time we'd be minus 24% short market beta. But we have these very large betas to the pure factor returns, very long growth, long quality, very short value. And that comes native from signal. Now, it could be because the analysts happen to be analysts who like growth stocks and don't like value stocks. It could be because your AI system or whatever generates it happens to have a bias for one reason or another. But it doesn't, again, we're not really worried about why that comes in on the alpha generating signal. What we are worried about is what we're going to do about it. So we decide to say, okay, let's take this signal with its inherent bias, whatever that might be, and let's create 5 portfolios that express that signal. But we create the 5 portfolios using the Sherpa processes, etc., which we've talked about in the previous webinars. But we create them with 5 different constraint sets, 5 different ex-ante constraints. What do we want the signal? What do we want the portfolio to do? So one of them, we don't care about factors. One of them, we want it to be explicitly long value. One, we want it to be explicitly long growth. One of them, we want all the factor exposures to be constrained to plus or minus 10% beta to the pure factor exposures. So very small or quite small factor exposures, and one much tighter, plus or minus 5%. So very, very small factor exposures. And if we build those portfolios and run them through time, and this is all out of sample, properly done portfolio running, we end up with 5 different return streams. So the 5 different lines on this graph, which is what we'll talk about going forward. But the 5 different results on this graph illustrate 5 different lived experiences of a portfolio. What would you experience as the investor or the portfolio manager, depending on how you decided ex-ante to treat factor exposures? You could have one of these 5 different lines. And you can see there's a pretty broad spread here, right? You can do very well, or you can just have volatility and no real return. But the 5 portfolios have the same alpha signal going into them, the same work which tries to identify excess return on the long and the short side goes into each of the 5 portfolios. You can see that the portfolios, this is their ex-ante factor exposures. So each of the 5 portfolios do what we said they would do. So first up, they're all market neutral and cash neutral. So we built them to be cash neutral, and we built them to have minimal, I mean, nominal market beta, minimal, nominal, or almost no real market exposure. The free portfolio, the first of our 5, in which we didn't constrain factor exposures, has residual factor exposure, which is, of course, the same type of exposure as in the signal, right? So we're short growth. We're a bit short value as well, actually. We're short growth. We've got this long quality. It's sort of kind of just, it's there because we didn't care about it, and it's what appeared. The value, the specifically defined value and growth portfolios do what we said they would do. So the long value has long value and short growth. The long growth has long growth and short value. Because of the way those two factors are sort of defined, they tend to be opposite of each other. And then the ones that we constrain to be within the narrow bands have factor exposures within the narrow band. So we have succeeded ex-ante in building the portfolio that exhibits the factor exposures that we want it to. So that's, you know, our portfolio construction has done what it said. And as a corollary, when you do a ex post risk attribution on these portfolios, and if you care about things like specific risk, which a lot of LPs, particularly leveraged money LPs, very much care about, you will find that the portfolios with constrained factor, the last two on the right, have very high specific risk, and of course very low risk to everything else, which is again what you want if you're in that business. So what, I mean, I've put I've sort of squished the graph up here a little bit on the right. This is the old returns. Previously, in the previous time period, so this was going up until first half of this year, or like I think we finished March, April. We had a very good performance from the yellow line there, which is the cash neutral, because it had residual factor exposure, and those factors happen to do very well. That's the point. And I'm going to show you where that comes from in a second. I mean, this is the kind of historical thing. I want to move forward actually onto the today's data. In the period from July to November, which is the period we're looking at now, we've got these return streams from the pure factor returns, the pure factors. And these return streams are constructed from taking the representative market set, so the Russell 1000, and taking the top, whether it's decile or 20 percentile, I'm not sure, of stocks that have high factor versus stocks that have low factor of whatever that factor is, so growth, building a long short portfolio of that and seeing how that performs. So pure factor returns. And you can see, I don't know, did I illustrate? Yeah. You can see that during this period, the factor returns sort of volatile, but not much direction, except for the risk factor, which we'll stick to one side. But in the last month or so, in the last couple of months, November particularly, you had this huge, as we know, this massive sell-off in momentum, and a big uptick in the value factor. And we're going to see how that reflects through in the portfolios over this time. So let's go back to what Stephen talked about, right? The three types of factor exposure you can have in your portfolio. You can have ones that you decide to take ex-ante deliberately. I want to be long growth, or I want to be long value, or whatever. You can be, I've decided I don't want any factor exposure. I want just the specific risk from my single stock alpha, and I want to be neutralized to the factor exposures. Or you can not care about it and have unintentional factor risk, which is a product of your alpha and actually the rest of your portfolio construction. So when you look at the factor targeted, so remember we had our 5 portfolios, and let's skip to the ones where we've specifically targeted factors, long value and long growth. The return stream, which is the graph on the left of those two factors, factor included portfolios, we can see what's going on, right? So the long value portfolio has done very well over the period. And you can see that the value factor return, pure factor return, which is the orange line on the right-hand graph, has also done quite well. So that yellow line on the left-hand graph consists of the alpha in your single stock selections, which there is some, we'll show that in a second, and expressed in a way that also includes the long value factor. So you get the double plus on that because you happen to be right on the factor exposure. The long growth portfolio, which is the blue line on the left-hand graph, conversely is very uninvestable. And it's uninvestable because, as well, by dint of being long growth, it is short value. So any alpha in the asset selection has been totally swamped by the basically residual short value factor in that portfolio, ending up with a return stream that is, very poor, right? No one's going to be happy with that. The free portfolio, so the portfolio we constructed to not care about factor exposures, but have residual factors or whatever it happens, ends up looking a little bit like the growth portfolio because it is, as you can see, short some value. The difference is, and this is quite important, although a bit subtle, it has much lower volatility. The volatility on the orange line is much lower than the blue line because, of course, it hasn't been forced into holding factor risk, which introduces volatility. It happens to have factor risk, but it hasn't been forced into having big factor risk. And that is giving you a damped volatility of returns. The Sherpa construction process generates portfolios with lower drawdowns and controlled risk, and that's what you want to have. But because you've got this residual factor exposure in it, you suffer from factor-driven alpha cancellation, call it, right? Single stock alpha is driving your portfolio up, but the residual factors is driving it down. But the volatility is damped by the portfolio construction process. The factor neutralized portfolios, and again, apologies, this one is gray, that was my bad. The blue one is the one that's constrained to be 10% residual beta on any factor, and the gray one is the one that's constrained to be 5% on residual factor. They both do much better, as you'd expect. They only have the asset selection alpha in them, right? They are a product of the decision to buy certain stocks and short certain other stocks expressed in a portfolio, and that's the point, right? Expressed in a portfolio in which there are no residual factor exposures. So the risk attribution of these portfolios is all, I mean, of the 5% one is extremely high just to specific stock selection. Very little of that gray line performance can be attributed to anything other than the pure single stock selection. And that's because the portfolio has been constructed deliberately ex-ante in that way. The blue line has, again, reasonable return stream, but more volatility because it has more residual factor exposure. Remember, we constrained that to 10% rather than 5% betas. When we look at all five portfolios next to each other, and this was, when we first introduced these five portfolios, at whatever is 10, 15 slides ago, you can see that, oh, hold on, so our factor constrained portfolio, our gray line, looks very good, but the yellow line is clearly much better. But that's the one, remember, that we deliberately chose ex-ante to be long value on. So we made a conscious ex-ante bet that value would do well, and it has done well. So we've received not only the alpha from our asset selection, we've also received a boost from the value factor. And there's nothing wrong with that. That's perfectly acceptable, but it is a conscious decision. If you don't take the conscious decision and you have the same alpha selections, you can easily achieve the orange line, which is a bad performance, clearly. You've got the same alpha from the asset selection, but your alpha has been swamped, has been decommissioned effectively by the residual factor exposures. So controlling your factor exposure can get you the nice gray line, taking the right factor exposure, you have made ex-ante, you have an ex-ante view and you are correct, will get you the orange line. Not caring about factors at all can get you the, sorry, will get you the yellow line, taking the right factor bet. Not caring about factors can get you the orange line, and taking the wrong factor bet can get you the blue line, broadly uninvestable volatility with no return. So if you, we just tabulated here what the return streams are. And again, we're sort of re-emphasizing again and again. Factor neutralized, there is 17 or 18% annualized alpha in this signal when expressed with no factors. When this, and I'll say that again, when you express this signal in a way that has all the 80+% of the risk, when done with a proper risk attribution, is attributed to the specific single stock selections and not to these big style factors or macro risks, etc., you can get 17 or 18% from the signal. So the signal has good value. You can get a much better return if you also take a factor bet and turn out to be correct. Very good, so you get the long value one. But from the same signal, you can get a much worse return. You can get nothing, 2% with a 5% drawdown and a 9 vol. So, uninvestable portfolio. You have spent time, energy, money on generating a signal. If you remember at the beginning, you've created this signal. This signal has alpha, so that has been money and time well spent. And remember the table of this is a +80, there's a -70. You have generated that table from your research. It works. It has real value. It can give you 17%, 18% if you neutralize your factors. If you take the right factor bet, you do well. On top of that, if you take the wrong factor bet, it can go down to 0. So taking stock of what you've got, what is your what's your edge? If your edge is single stock research, and whether this is long short or long benchmark, it's exactly the same process. If your edge is single stock research, deciding ex ante how you want to express that within your portfolio is extremely important. Your research may have a factor bias. Your investors may want a factor bias. You may have set out to have a factor bias, which is perfectly acceptable. You can express that all the way through. Your research may be purely single stock, in which case you need to decide ex ante, do you want to express it with factor, with deliberate factor or controlled factor, or forget about factors and live with the resultant extra volatility that comes from it. So if you have, I'll read this one out because it's so clearly written, if you have ex-ante factor exposure in your portfolio, which derive from your alpha selections, you will have factor-driven returns. Now, factors are so widely watched and used by the markets that they do have, although they are sort of mathematical constructs, artifacts of multidimensional risk, they end up having a very big impact because they're so big and so widely watched. These factor returns can swamp the alpha in your single stock selection. So if you think about it from a business point of view, if you have spent, I don't know, you've got a team of 20 analysts, so you're spending $10 million a year on analysis, and you end up converting that analysis into a portfolio which has a large factor bet, which comes from either a deliberate or a non-deliberate decision. That decision can swamp the value that you've created in spending the 10 million on doing the analysis. And that's an important business point. Factor risk isn't necessarily bad. If you get it right, of course, you'll do very well. But as you've seen in the last few months from this, the massive momentum sell-off, the massive big pickup in the value, people were surprised by those. Most people were surprised by those. If you don't think that's your edge, then you should have a process which neutralizes that in your portfolios. Again, if you don't think ex-ante factor betting is your edge, then have a process in place which allows you to express your alpha in a factor neutral manner. Right? Take your alpha, express it, don't be swamped by things that are out of your control, if that's not your edge. Right? Not taking a conscious decision on this is the equivalent of a bet, but it's a bet you don't actually know which way around you are until the P&L comes in. Right? So it's definitely worth considering these things. I guess I should say, from our point of view, Sherpa is heavily involved both in calculating ex-ante factor exposures, constructing portfolios that express investor, LP, and GP desired factor exposures, and ex post demonstrating through risk attribution that these portfolios do what they said on the tin, right? Which is what makes them investable. So please feel free, give us a shout if you want any discussion on these points, any help about how to build these factor exposures or do otherwise. Stephen, are you able to hear me still?
Yes.
Okay. You've got a hell of an echo there.
There's an echo there. We've had some audio issues here. So for everyone who's been involved in, thanks for bearing with us through the technical issues today. I think, Richard, you did a great job walking through that. And again, as far as we're concerned, and the Sherpa process, what Sherpa is all about, with market risk, with factor risk, we talk about helping PMs take the risk they want and not the risk they don't. And this is just another angle of that, whether it be macro risks, whether it be factor risks, whether it be market risks. It's about building a portfolio that expresses your alpha in a way that you are taking the risk you want and the risk that your investors want. So if you have a chance, if you aren't doing this already as part of your process, by all means, please reach out to us. We have all of our contact information below. Richard, otherwise, thank you for taking the time today. We'll have this up on the Sherpa YouTube channel, so if you missed part of it, should be up later today or tomorrow, and we'll certainly let everyone know once it's online. So thanks, everyone, for joining us. Richard, any last words?
No, once again, Stephen, thank you very much for your work. This is the last of our webinars for this year, and thank you for your work in setting all these up and getting these going. So I hope everyone's, I don't know, enjoy, but hope everyone has found some value in these webinars. The whole series covers everything from portfolio construction, seeing what a portfolio looks like, candidate portfolios, taking risk, being active, et cetera, So please do dip in and out of those. There's lots of value in them. And again, thank you very much all for time and effort.
Forward to some new Sherpa Funds tech process alpha portfolio construction topics as we get started in January of 2021. So everyone stay safe. Richard, thank you. And we will look forward to hosting everyone again soon.
Cheers, guys.
Right.